Next is the owner's equity. Okay, in companies, a normal type of equity for a company is called shares. In other parts of the world, it's called stocks. Okay, in Malaysia, in United Kingdom, for example, we use the word share. Okay, so there are two types of shares: the equity shares and the preference shares. A preference share is a share that does not entitle the holder to the right to vote. Okay, so a person that buys a preference share from a company does not have the right to vote in the annual general meeting of the company. However, whenever dividend is distributed, or if the company is liquidated and there are assets to be distributed among the shareholders, then the preference shareholders will be getting the first of the distribution, will first be given the dividend and will be first in receiving the liquidation. The equity shares holders have the right to vote in the AGM. However, they whenever dividend is distributed, or when company is liquidated and there are assets to be distributed, then they will be the last party to get the benefit out of it. Okay, so whenever dividend is declared, then the preference shareholders will be getting the dividend first, and any remaining out of dividend will be given to the equity shareholders. So under the capital, under the equity of the companies, besides having capital or the shares, the other sources of equity is the retained earnings. So retained earnings is any remaining profit after tax and after dividend that is rolled back. Okay, that is not distributed but rolled back by the company to be used in future years. That is called retained earnings, and retained earnings will be part of the equity. So retained earnings is a net income that a corporation retains for future use. So whenever a particular year the company achieves some profit, but that profit is not distributed to the shareholders in terms of dividends, that profit is used for funding in the future operation of the business. That is called retained earnings, and retained earnings is part of the equity. Let's see the differences in the capital account of the three types of organizations. So firstly is the proprietorship. So in proprietorship, we will have one owner's capital account. In partnership, we will have capital accounts for each of the partners. So for example, in this partnership, there are two people, one is Abel, one is Baker. Then we will have two capital accounts, one for each of the partners. But for corporations, we have equity share account, and if we also have preference share accounts, but we also have another account which is retained earnings. Okay, because retained earnings we do not distribute it to the any particular shareholder, but instead we roll in our business. Therefore, we need to have an account called retained earnings. Okay, let's see the differences between the equity shares as well as the preference shares. I have briefly explained before. So firstly, equity shareholders will have the right to vote in the election of board directors and on actions that require shareholder approval. So whenever the company needs to decide on something that needs to be voted, then equity shareholders have the right to vote. Equity shareholders will have a share of the corporate earnings whenever there's a distribution of dividends. And when the company is liquidated, probably when they go out of business, the equity shareholders will have the claim on the residual balance. Whatever is left will end up going back to the shareholders. So for example, if a company liquidates, it has $1 million worth of assets, and 500,000 is paid to lenders and creditors, and the remaining 500,000 will be distributed among the shareholders. Let's see how we do the accounts for the issuance of equity shares. Okay, assume that Berhad is limited. Okay, so this is the name of a company. Berhad issues 1,000 shares of equity shares for 5 ringgit per share. Okay, so Berhad, in order to obtain cash for the business, they issued 1,000 equity shares, units of equity shares. Because the company receives 500 ringgit per share, and there are 1,000 units of shares being sold, so therefore the company will receive cash of $5,000. So we will 5,000 ringgit. So we will debit cash by 5,000 ringgit, and we will credit equity shares by 5,000 ringgit. So equity shares will be the account under the owner's equity. But sometimes equity shares are issued not in lieu of cash, but in lieu of other types of assets. Okay. So for example, a corporation also may issue share for services. Okay, so they may issue shares in order to get services from attorneys or consultants, and they may issue shares to get non-cash assets such as land, buildings, and equipment. So the issuance of shares is recorded. It will be recorded at cost, but cost is considered as either the fair market value of the consideration given up, or the fair market value of the consideration received, whichever is more clearly determinable. Whichever of these two is more objective, that would be the cost to be considered for the share. So let's see an example here. In going through the incorporation process, they engage the services of attorneys, and that's the value of the services is 5,000 ringgit. So the attorneys agree to accept 4,000 equity shares in payment of their bill. At the time of the exchange, there is no established market price for the share. The objective amount is the 5,000 ringgit bill. Okay, so that will be the consideration for the transaction. So the journal entry for this transaction is we debit organizational expense. So okay, because it's an expense, so we debit the expense account for $5,000. Okay, so the equity shares is credited by $5,000, and what is the value of the share price? It is $5,000 divided by 4,000 units of shares. Therefore, each unit of share issued to the attorneys is 1 ringgit and 25 cents. This is the issue price of the equity share. Another example, Berhad is an existing publicly held corporation. Its equity share is actively traded at 8 ringgit per share. The company issues 10,000 equity shares to acquire land recently advertised for sale at 90,000 ringgit. Prepare the journal entry of this transaction. Okay, so to know the value of the value of the share issued, that should be considered in our accounts. We should look at which of the amount is the more objective amount. Okay, so it says here that its equity share is actively traded at 8 ringgit per share. Whenever there's a different transaction regarding equity share for the company, it is currently at 8 ringgit. So that is more objective. The land is advertised as 90,000, but usually the amount as advertised and the actual amount paid for it might differ. So this is not as objective as the 8 ringgit. Therefore, we will use 8 ringgit per share as the amount traded for the issuance of shares. So we debit land for 80,000 ringgit, okay, which is 8 ringgit times 10,000 shares. and we credit equity shares by 80,000 ringgit. So this is the recording for the issuance of shares in order to obtain land. The second type of shares is the preference shares. The features often associated with preference shares is firstly preference as to dividends. So whenever dividend is declared to be distributed among the shareholders, the preference shareholders will be the first persons to be given the dividends before the equity shareholders. Whenever there's an asset from liquidation of the company, those assets will be distributed among the preference shares before distributed among the equity shareholders. However, the preference shareholders are not allowed to vote. In terms of the accounting, for preference shares, whenever preference shares is issued, it is similar to the issuance of equity shares like the examples we've shown before. So for example here, Berhad issues 10,000 units of 8% preference shares. So 8% preference, 8% here refers to the dividend. A dividend that usually being promised to preference shareholders whenever dividend is distributed. Okay, so Berhad issues 10,000 units of preference shares for $12 cash per share. So the transaction will be cash 120,000, because this is from 12 ringgit per share times 10,000 units. So it's preference shares 10,000 times 12 ringgit per share, which comes up to 120,000 ringgit. So debit cash and credit preference shares. This is how shares, both equity shares and preference shares, are shown in the balance sheet. Okay, for companies, for corporations, usually the term for balance sheet uses statement of financial position. This is the same as balance sheet, only the term is different. So under the shareholders equity section of the balance sheet, there's the paid up capital, and paid up capital is divided into two. One is for the equity shares and one is for the preference shares. So whenever the types of shares is disclosed in the balance sheet, we would also need to show the amount of units. Okay, so 15,000 units of equity shares amounting to 90,000, and then 10,000 units of 8% preference shares. Again, 8% here refers to the dividend percentage. Okay, so 10,000 units of preference shares valued at 120,000. So this is the paid up capital. And then under shareholders equity, the second part is the retained earnings. This retained earnings referring to the profit and loss that has been returned, accumulated for the previous years. Okay, so retained earnings 112,000. So total up the paid up capital with the retained earnings will be the total shareholders equity. This is a part of the statement of financial position or the balance sheet.